There was a time when buying a home felt like crossing a line into stability. Not comfort, not wealth, just a quiet sense that the unpredictable parts of life had been reduced. You locked in a mortgage. You knew what you owed, and over time, that number became easier to carry. But something has shifted. Today, many homeowners are earning more than they did 5 or 10 years ago. Their mortgages are fixed, their incomes have grown. And yet, the feeling is different. The numbers don't behave the way they used to. Costs appear in places that once felt stable. Insurance renewals, property taxes, repairs that don't wait. Nothing dramatic happens all at once. No single bill breaks the system. But slowly the margin disappears. What used to feel like ownership begins to feel like maintenance. And for many, the question is no longer whether they can buy a home, but whether they can continue to keep it. Because the real change isn't the price of houses. It's the cost of holding on to one. In 2015, the financial logic of owning a home was relatively straightforward. In cities like Phoenix, Tampa, or Dallas, the median home price hovered between $180,000 and $250,000. Mortgage rates were higher than the historic lows that would come later, but monthly payments remained predictable. If you earned a stable income and avoided major disruptions, the math tended to hold. Your largest expense was fixed, and over time, inflation worked quietly in your favor. By 2021, something changed. Mortgage rates dropped below 3% for the first time in modern history. Demand surged. Home prices accelerated at a pace not seen in decades. In Phoenix, the median home price rose from around $220,000 in 2015 to over $430,000 by 2022. In Tampa, it nearly doubled. Across much of the country, prices increased 30% to 60% within just a few years. At first glance, this looked like a familiar housing cycle: supply, demand, low interest rates. But beneath that, a different layer was forming. Because while home prices surged, so did the cost of everything attached to them. Take property taxes. In Texas, where there is no state income tax, local governments rely heavily on property taxes. As home values increased, tax assessments followed. A homeowner paying $4,000 annually in 2018 might now be paying $7,000 or more, not because they moved, but because the system recalculated what their home was worth. Then came insurance. In Florida, average home insurance premiums have more than doubled in recent years. Some homeowners now pay over $6,000 to $10,000 annually if they can get coverage at all. Major insurers have exited the state entirely. Others have tightened underwriting standards or raised deductibles. This isn't random. Insurance companies price risk, and the risk from hurricanes, floods, and rebuilding costs has increased. But the cost doesn't stay with the insurer. It moves from the balance sheet of the company to the monthly budget of the homeowner. Then there is maintenance. Construction costs have risen significantly since 2020. Labor shortages, material inflation, and supply chain disruptions have pushed up the price of even basic repairs. A roof that might have cost $8,000 a decade ago can now cost $15,000 or more. HV, AC, replacements, plumbing, electrical, all trending upward. And unlike a mortgage, these costs don't arrive in predictable monthly installments. They arrive suddenly, and often at the worst possible time. Even utilities, once a minor variable, have shifted. In states facing extreme weather energy, bills have become more volatile. Cooling costs in Arizona, heating costs in the Midwest, water pricing in drought-affected regions. Each one on its own seems manageable, but together they form a different kind of structure. Because the modern cost of homeownership is no longer just a mortgage. It's a stack, a layered system of obligations, some fixed, some variable, some invisible until they appear. And unlike the past, this stack doesn't necessarily shrink over time. In many cases, it grows, which raises a quieter question. If the cost of owning the home is no longer stable, what exactly are homeowners holding on to? Daniel is 39 years old. He lives in the outskirts of Phoenix, Arizona, in a 3-bedroom house he bought in late 2020. At the time, it felt like a responsible decision. Interest rates were low. The monthly payment fit comfortably within his budget. Daniel works as a project manager for a logistics company. His gross income is about $7,200 a month. After taxes and deductions, he takes home roughly $5,400. His mortgage is fixed at $2,150 per month. That number hasn't changed since the day he signed the papers. And that's where the sense of stability used to come from. But the rest didn't stay still. In 2021, his annual home insurance premium was $1,800. By 2025, it had risen to $3,900. At first, it increased gradually. Then one year, it jumped by nearly 40%. No claims, no major changes, just a new risk calculation. His property taxes followed a similar path. When he bought the house, he was paying around $3,200 a year. Now it's closer to $5,600. The home didn't change, but its assessed value did. Then came maintenance. In the summer of 2024, his air conditioning system failed during a heat wave. Replacement cost $11,500. He didn't have that in cash, so he financed it. That added another $320 per month. Now, if you map his monthly reality, it looks different than it did when he first bought the home. Mortgage, $2,150. Insurance, $325. Property tax monthly equivalent, $470. Utilities average $450. Maintenance financing, $320. Groceries, $900. Car payment plus insurance, $780. Health insurance plus out-of-pocket, $600. Total, $5,995. His take-home income, $5,400. On paper, Daniel is short about $600 every month. There's no single catastrophic event here. No job loss, no medical emergency. Just a series of adjustments. Each one individually explainable. Each one in isolation manageable. But together they create something harder to see. A structural deficit. So Daniel adapts. He cuts discretionary spending. He delays replacing aging appliances. He uses credit cards occasionally just to smooth the timing. Nothing extreme. Nothing that would trigger alarm. But over time, the pattern forms. His house, once a symbol of stability, now behaves like a system he has to constantly manage. Not own, manage. And that shift is subtle enough that it doesn't feel like a crisis. It just feels heavier, which raises a deeper question. If someone like Daniel's stable income fixed mortgage, no major disruptions, is already running a deficit, then what exactly changed in the system around him? What changed around Daniel wasn't a single market. It was the way multiple systems began to move at the same time. For decades, homeownership in the United States operated on a quiet assumption. You fixed your largest cost, the mortgage, and everything else would remain relatively secondary. Insurance was background noise. Property taxes moved slowly. Maintenance was occasional, not structural. That assumption no longer holds. Because each layer of cost is now being driven by a different force, and none of them are designed to stabilize the homeowner. Start with insurance. Insurance is not priced based on what you can afford. It is priced based on risk and increasingly on uncertainty. Over the past decade, climate-related events have become more frequent and more expensive. Wildfires in California, hurricanes in Florida, flooding in parts of Texas and the Midwest. For insurers, this changes the equation. The question is no longer, what is the average loss? It becomes, what is the worst-case scenario? And how often could it happen? As that calculation shifts, premiums follow. Some companies raise prices, others reduce coverage, and some leave entire regions altogether. When they exit, the remaining options become more expensive, sometimes dramatically so. The system doesn't absorb the risk, it transfers it. From the institution to the individual homeowner. Then there are property taxes. Local governments depend heavily on property tax revenue to fund schools' infrastructure and public services. As home values increase, tax assessments adjust upward. But here's the detail that often goes unnoticed. Property taxes don't care how you purchased your home. They don't care if your mortgage is fixed. They don't adjust based on your income. They follow valuation, which means homeowners can experience rising costs without any change in their financial capacity to absorb them. And because these adjustments happen gradually, they rarely feel like a shock. They feel like a drift. Then comes maintenance, the least visible, but often the most disruptive layer. Homes age, systems degrade, materials fail. But the cost of fixing those things is no longer anchored to past expectations. Construction labor shortages, higher material costs, and supply chain volatility have shifted the baseline. What used to be a manageable repair can now become a financing decision. And unlike a mortgage, maintenance has no fixed schedule. It arrives unpredictably, but inevitably. At the same time, the housing market itself has been financialized in new ways. Institutional investors have entered residential real estate at scale. In some markets, they compete directly with individual buyers. This affects pricing, but it also affects behavior. Homes are no longer just places to live. They are assets within portfolios. Vehicles for yield, units in a broader financial system. And that changes how supply, pricing, and risk are distributed. Because systems designed for investment don't always align with the needs of people seeking stability. What emerges from all of this is not a single failure point. It's a structure. Each layer, insurance, taxes, maintenance, market dynamics, operates independently. Each one makes sense within its own logic. But when they converge on a single household, they don't cancel each other out. They compound. And the homeowner becomes the point where all of those pressures meet. Not because of a bad decision, not because of mismanagement, but because the system around the home has been reconfigured. Quietly, gradually, and without ever formally announcing that the rules had changed. Which leads to something less visible, but often more persistent than financial strain. At first, the changes register as numbers. A higher insurance bill. A tax notice that's slightly larger than expected. A repair that costs more than it used to. Individually, none of these feel like a crisis. They can be explained, justified, absorbed. But the human brain doesn't process them in isolation. It processes accumulation. Over time, what Daniel experiences isn't just a tighter budget, it's a shift in how he relates to his own stability. The house is still there. The mortgage is still fixed. But the predictability is gone. And predictability is what allows the mind to rest. Without it, something else begins to take its place. Low-grade, persistent stress. Not the kind that spikes and resolves, but the kind that lingers. Every unexpected cost becomes a signal. Every renewal notice carries uncertainty. Not because something bad has happened, but because something might. This is where financial pressure becomes psychological. The body doesn't distinguish between immediate danger and prolonged uncertainty. It responds with the same system. Elevated cortisol, heightened vigilance, a constant scanning for what could go wrong next. And over time, that has consequences. Decision-making becomes narrower. Long-term planning starts to shrink. Daniel begins delaying things he would have done before. He puts off replacing older appliances. He hesitates before committing to vacations. He avoids looking too closely at future expenses. Not out of irresponsibility, but because every decision now carries more weight. This is known as decision fatigue. When too many small uncertainties stack together, the mind starts conserving energy. It chooses avoidance over optimization, and slowly a different pattern forms. The goal is no longer progress, it's stability. But even stability begins to feel temporary, because each layer of cost introduces a new variable, and each variable reduces the sense of control. What makes this especially difficult to recognize is that nothing has failed. Daniel still has his job, he still owns his home, he still pays his bills. From the outside, everything looks intact, but internally the experience has shifted. Ownership used to feel like security. Now it feels like exposure. Exposure to systems he cannot influence, to costs he cannot predict, to risks he cannot fully measure. And that creates a subtle but powerful tension, because the very thing that was supposed to reduce uncertainty has become a source of it. Which leads to a final question. If the structure of homeownership has changed, what does that mean for what comes next? For a long time, owning a home in America followed a familiar narrative. You bought stability, you locked in your costs, and over time life became more predictable. The house didn't just represent shelter, it represented control. Control over your expenses, control over your future, control over the unknown. But that narrative depended on something quiet. That the system around the home would remain relatively stable. That insurance would stay in the background. That taxes would move slowly. That maintenance would be occasional. That assumption is no longer guaranteed. What has changed is not the idea of ownership, but the environment that surrounds it. A home today exists inside a network of shifting costs, recalculated risks, and external forces that don't move in sync with income. And when those forces begin to align, they don't break ownership all at once. They stretch it, gradually, almost invisibly, until stability becomes something that has to be maintained, rather than something that simply exists. The structure didn't collapse. It adapted. And in doing so, it quietly changed what it means to own something at all. So the question is no longer just whether a home is affordable when you buy it. It's whether over time it remains something you can continue to hold, or something you are constantly trying to keep from slipping away.